Recently, someone from my YouTube channel that was watching my videos decided to reach out to me about his tax returns. You see, this gentleman, he runs a small marketing agency that he started about a year and a half ago. And from all I could tell from talking to him, he's a smart guy, he's hardworking. The problem that he was complaining about and why he was reaching out to me is that he just got his tax return back from his CPA and he was furious. He said, my CPA does not understand the strategies that you're talking about, and he's disallowing a ton of the deductions that I'm claiming. You see, here's what happened. So about a year and a half ago, when Ryan started his business, he'd been watching Instagram, TikTok is what I imagine, and he saw some 20 to 30-year-olds on there and rented Lamborghinis, and they're telling them, and you see this probably all the time, hey, if you don't have an LLC, you can't write off a single thing. You're literally giving the IRS free money. I see these videos all the time. And so what Ryan did to start his new marketing company is he set up an LLC. Now, there's nothing wrong with setting up a limited liability company for your business. But if you do that with the expectation that when you set up your LLC, you get your bank account set up and you start running everything through it, that everything becomes a deduction, right? So he bought a laptop, he invests in software and internet and things of that nature that are used in his business. That's fine. But then taking his car and running that through his business, his personal car, taking his girlfriend out to dinner, and then they talk about the business over dessert, or maybe he's buying clothes so he can look better on Instagram, and he's going to the gym and calling it, business meetings because clients can be found there at the gym. See, all of these things were expenses that he was incurring that he thought he could deduct. And this is where he was so upset, because his tax bill was much higher than what he had anticipated. And he came asking, what could we do to help him reduce it? Because he figured his CPA got it all wrong. We see, that's the problem. Here's what nobody told Ryan. Okay, about half the stuff he ran through his business, and I had to share this awful truth with him, of course, is that he could have deducted it anyway, that the LLC did not make a difference in those deductions, okay? The other half, well, most of it was not deductible. It doesn't matter if you have an LLC or not, and this is a problem that I see all the time. Now, on social media, people are portraying that if you set up a limited liability company, then the tax code suddenly expands. And Ryan paid to set up an entity he didn't need, because if he was doing it strictly for tax savings, well, it didn't make a difference for him because he was still running personal expenses through there. So if you've ever been told you need an LLC to write things off, this video is going to be for you, because the people telling you this are flat out wrong. The truth is going to save you a ton of money. If you just watch this, you're going to understand what is a legitimate business deduction. So my name is Clint Coons with Anderson Business Advisors, and I've been doing this for over 27 years. And I've watched this exact myth wreck more for first-year businesses than I can count. Why? Well, let me break it down for you. Okay, so here's the myth that comes on all the time. You need an LLC to claim write-offs. Without one, your expenses are going to be limited, and that's just not true, right? As I stated earlier, TikTok, YouTube Shorts, Instagram, the pitch is always the same. Form an LLC and unlock deductions. You see, the LLC associated with real businesses, so the deductions must come with it, is completely wrong. Top to bottom. It's wrong because deductibility, whether it's the IRS lets you write something off, has nothing to do with the type of entity you're running or whether you have one at all. It all comes down to three things, okay? There's a three-part test here that the IRS looks at, right? It does nothing to do with an LLC. And if you fail one, then any entity you've set up, LLC, corporation, it's not going to protect you. So what is the first one? First one is it has to be ordinary. And that means the kind of expense that is commonly expected in your line of work. So a graphic designer, say buying Adobe, that's going to be an ordinary necessary business expense or an ordinary business expense. A contractor, of course, what are they going to buy? A skill saw, nail guns. Those are all deductions. A consultant flying across country to meet with a prospective client, that's ordinary. So the IRS isn't going to ask you whether you personally do this all the time. It's asking whether people in your industry are typically engaged in this type of activity. Now keep in mind that there's always exceptions to everything here, but that's just the general litmus test. Now the second thing they have to ask yourself, and this is part of the IRS's test, is is it necessary? And what do we mean by that? Necessary doesn't mean it's indispensable. It means, is it helpful? Is it appropriate for the business? You don't have to prove you couldn't possibly survive without it. You just have to show it serves your business. All right. And then 3, can you substantiate it? And this is where most people fail, because substantiation means receipts, invoices, mileage logs, calendar entries, proof that the expense actually happened. And here's what's more important. What was it for? And that it was business related. You see, the IRS calls this books and records. And that's why if you watch my videos, periodically I will say how important it is to have good books and records, not only from an audit standpoint, but also from an asset protection standpoint. That is, so they can't pierce your corporate veil. And more from a business standpoint. If you're looking to expand your business, you want to get loans, banks are going to want to see your books and records. So if you can't substantiate it, it doesn't matter how ordinary and necessary it was, you're going to lose the deduction. So what am I getting at here? Okay, look at Internal Revenue Code 162A. And basically that revenue code pretty much covers all this. And it states, there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. Hey, that's the actual statute, Section 162 of the Internal Revenue Code. It's pretty straightforward, right? Read it carefully, though. You'll notice something's missing. Nowhere in that statute that I just read does it say you have to have an LLC. It doesn't say you have to have a corporation. It doesn't say you have to form an entity, all right? It says you just have to carry on a trade or business, and that's it. So which brings us to the small rectangle of paper that's been hanging around since long before LLCs existed. That's called Schedule C. You see, Schedule C is a form a sole proprietor uses to report business income or expenses on their personal tax return. And if you're operating a business, a side hustle, a hobby that has started making money, anything you do with the intent to profit that falls under Section 162, you're going to be able to write off those expenses under that section. Okay, you don't have to register anything. And the minute you start operating with the intent to make a profit, you're in business. Now, of course, Schedule C, we bemoan them all the time until you do not file as a Schedule C sole proprietor, because there's a lot of issues. I'll talk about, liability, but there's also you're at a greater risk of audit. My purpose in bringing up the Schedule C sole proprietor has nothing to do with its drawbacks from a business standpoint. It has to do with the fact that when it comes to deductions, ordinary business deductions that are necessary, you don't need an LLC. So don't fall into this trap that unless you have an LLC, you're not going to start your business. You're not going to try to take any deductions because they're going to be disallowed. That's just bad information. And unfortunately, this myth keeps spreading. Okay, so then why did Ryan form an LLC, or what should have been his intent? Well, let me just show you what we're talking about here. And this is why we set up businesses for people just like Ryan all the time. So the reason why you want to create a limited liability company here to run your business out of is that when you're down here and you're as the owner of this LLC, so let's say this is Ryan right here. Let's assume this person over here, okay, is Kim. And they're both engaging in the same business activity. Let's say it's marketing. Okay, so Ryan's running his business activity here out of his company. So he's dealing with third parties out of that LLC. They're entering into contracts with that limited liability company, where Kim's doing it all out of her personal name. Now let's assume that they've each contracted with this business here. And this business is going to assist them by coaching them on how to build up their marketing business. And so the business now over here, I'll just put coach there, enters into a 1-year agreement with both of these individuals. Now with Kim, they're going to enter into it in their own name. And with Ryan, they're going to enter into it in the name of his limited liability company. And they're going to charge, let's say $4,000 a month for this coaching service. Hey, we're going to take your business to the next level. Now, some of you watching this have probably been involved with a company like that before. Now, in my experience in working with clients who have used this, there's good ones and there's bad ones. Let's say this is one of the bad ones here. And you're into this 3 months into this agreement and they have generated 0 revenue for you. So what is your option then? Are you going to continue paying them Probably not, because that's just $4,000 going out the door where you have no return on that spend. So Ryan cancels it, sends a letter and says, hey, I'm stopping all services with you. Kim does the same thing. Now here's what happens. The coaching company then is going to send Ryan's business a letter, and they're going to send him the agreement. They say, you entered into a 1-year agreement with us. And that agreement was discounted to $4,000 a month. Normally, we charge $8,000 a month for this service. If you cancel now, then you're going to be liable for $8,000 a month per the end of the term per our agreement. So Ryan's looking at this right now, and he's staring down $72,000, right? That they're going to come after him for under that agreement. But it's not him, right? They're going to go after his LLC. This is why Ryan created his limited liability company. Whereas Kim, they're going to go after her directly for $72K. Now, here's where that is so important. You have to understand this if you're starting a new business. Is that $72,000, if they get a judgment against Kim, that's going to stick to her personal residence if she has a house. Her bank account can be garnished. All of her personal assets, a judgment's going to follow her around. Whereas with Ryan, it goes against his LLC. So if his LLC had $2,000 in it, then the most he stands to lose is $2K. So setting up the LLC is not for creating a bunch more tax deductions, all right? That's not going to change. If Kim and Ryan were running these same businesses, if the deduction is ordinary and necessary, right? Okay, then it becomes a deduction to the business. Either one, sole proprietor or limited liability company. So in this context here, the LLC, as I stated, does not matter. Now, one other aspect here that is important, that why you would create an LLC for your business just beyond ordinary business deductions, is that when you start making money in your business, the benefit of having a limited liability company is it allows you to then elect a different tax status, meaning Kim's always going to be locked in as a sole proprietor. So what does that mean to Kim, since she's a sole proprietor running her business? Well, let's assume that Kim, everything's working really well right now, and she's making $80,000 a year. Well, this is going to be subject to employment tax. All right, so that means there's an extra 15.3% of that will be subject to taxation for your Social Security and Medicaid tax. So essentially you're looking there on that deal, what is that going to be? $8,000, $12,000 in employment taxes she will have to pay, and then income taxes as well on her $80K in earnings. But you see, Ryan created a limited liability company over here. And on the advice of his counsel here at Anderson, we told Ryan, of course, hey, if you're going to set up an LLC, now you're making $80K a year, we're going to make an S election to treat it as an S corporation for federal tax purposes. And when your $80K comes in, we will give you a salary of $40,000. Okay? That will be subject to employment taxes because that is considered active income. Sole proprietors, all your income is active. When you have an LLC taxed as an S corp, the only active income is your salary. So your $40,000 will be subject to employment taxes, which means you're going to pay $6K in taxes, right? $6,000. Look at that. You cut it by 50% by having that S corporation set up because you just now have bifurcated what is active income by paying a salary and then taking the remaining portion here, the remaining 40 that you didn't pay out as a salary, as a distribution. A distribution is subject to taxes, ordinary income taxes, but it's not subject to employment taxes. So this is the strategy here in setting up the LLC and why you want to do it. So when you hear again what people say, have you got to have an LLC to take your business deductions? Not true. You need an LLC for your business in order to protect yourself from liability and to make sure you can then take your active income and cut your employment taxes. This strategy has been around for a long time, and it's something that savvy business owners have realized that by using a structure in this manner, it's going to put more money back in your pocket. Running personal expenses through an LLC is not going to do that. It's just going to get you audited. Hey guys, if you liked the video, be sure to hit the like button. And as you know, if you've watched my other videos, Love to provide you a free strategy session. It's in the show notes below. Just go down there. You'll find a link. Click on it. Get your strategy session scheduled now. And again, I wish you the very best with your business or your investing.